Why is the Nikkei 225 surging today? The yen slide and corporate earnings upgrades are fueling a speculative chase, but with RSI above 76, the risk of a sharp mean reversion is real. This Nikkei 225 resistance 68,472 has capped the move so far. A daily close above it opens a path to 69,202 and 70,663. For support and resistance levels, watch 66,281 as the bull or bear pivot. The Nikkei just exploded 2.6% in a single session. It's trading at 68,400, kissing all-time highs. But here's what the crowd isn't seeing. The 14-day RSI is nailed at 76, and the stochastic is pinned at 96. The last two times we had a reading this extreme on the Nikkei, a 1,000-point air pocket opened within 48 hours. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm giving you 3 exact levels you can trade tomorrow. Levels that separate the institutions from the herd. Let's cut straight to the instant market verdict. The trend is unequivocally strong buy on every time frame: monthly, weekly, daily, 4-hour, 1-hour. But we are at a critical inflection point where momentum extremes collide with a brick wall resistance. The session bias is bullish trend, fading only if a specific level breaks. Write this number down: 66,281. If we print a daily close below 66,281, the entire structure resets. This breakout morphs into a massive bull trap that could unwind 600 points in a single day. That's the invalidation line. Herd positioning right now is overwhelmingly long, retail sentiment is euphoric, call buying is surging, and that complacency is exactly why a trap could be so vicious. Institutions love to squeeze the late longs into a blow-off top and then reverse hard. Now let's walk through the technical deep dive that most traders never bother to do. Pull up your weekly chart. The Nikkei is in a parabolic advance that has left every single moving average in the dust. The 200-week moving average is all the way down at 54,048. That's how extended this trend truly is. The 5-week, 10-week, and 20-week MARs are so far below that any pullback towards 62,000 would still keep the bullish structure intact. The weekly MACD is vertical, no sign of a crossover, but the histogram is starting to flatten just a hair. The first whisper of waning momentum dropped to the daily time frame. Here, the moving average ribbon is stacked perfectly bullish. The 5-day EMA at 67,221 and the 10-day EMA at 65,988 are the dynamic supports that have held this rally without exception. The 20-day EMA sits at 64,423. That's the line in the sand for any trend follower. The MACD on the daily is printing its highest reading ever, 2,138. But here's the hidden detail. Look at the 4-hour chart. The 4-hour MACD is still making higher highs in the signal line, but the histogram bars are not confirming the new price peak. We are seeing a classic bearish divergence. Price pushes to 68,400, yet the momentum bars are printing lower. That's exhaustion. Most traders miss this because they only watch the crossover. This divergence is a yellow flag, not a sell signal yet, but it tells you the buying pressure is thinning. Now the 60-minute chart. The 20-period MA on the 60-minute is at 67,900. Price is holding above it, so intraday momentum is still positive. The 200-period MA on the hourlies is at 65,100, far below, confirming the steepness of the climb. The intraday RSI on the 60-minute has rolled over slightly from 80 to 75, still overbought. The critical daily resistance is right where we are now, 68,472. That's the level. A clean break above it, with a daily close, opens the path to 69,202, then the psychological magnet of 70,663. On the downside, key daily supports are 66,281. That's the prior breakout point, then 64,820, and ultimately 64,090. Here's what most traders miss. The Nikkei is not moving in isolation. It's the BOJ's Frankenstein, a monster built on ultra-easy money and a perpetually weak yen. Every tick higher in this index is a bet that the Bank of Japan will never normalize policy. So cross-linkage is everything. Watch US dollar to Japanese yen. If dollar yen starts to roll over from its own extreme highs, the yen strengthens, and Nikkei will get crushed by a repatriation flow. Gold and bonds are also signaling a subtle flight to safety. Real yields collapsing. That's a loud alarm for equity risk. So while the chart looks invincible, the cross-asset web is starting to show cracks. That's the trap being laid, now, fundamental driver and cross-linkage in plain terms. Yesterday's core news, Japan stocks higher at the close, Nikkei up 2.61%, was fueled by a further slide in the yen and a batch of upward corporate earnings revisions. The market is pricing in a perfect Goldilocks scenario, a weak yen boosting exporters, and the BOJ staying on hold forever. But here's the fragility. Tomorrow's BOJ minutes from the last meeting will be scanned for any hint of a tweak to yield curve control. Even a whisper of "we discussed adjusting the band" will send the yen surging and the Nikkei into freefall. Additionally, US yields are creeping higher. The 10-year yield is sniffing at a breakout of its own. If that accelerates, it drags global equities lower and exposes the overloved Nikkei to a violent mean reversion. My 1 to 2 week directional lean is bullish above 66,281. As long as that level holds, the path of least resistance is towards 70,600. However, the exact event that invalidates this lean is a daily close below 66,281. If that happens, I'll turn neutral immediately and look for a test of 64,800. The market is pricing in infinite BOJ dovishness, and any crack in that narrative is the pin that lets get some interaction going. Do you think the Nikkei hits 70,000 this week? Comment yes or no right now. I'm tracking consensus to see how many of you are still chasing the melt-up versus preparing for the trap. Alright, it's time for the section that most people skip, the actual trade setups. And that's exactly where the money is made. Keep watching, because I'm giving you 3 distinct plans that cover every possible scenario tomorrow. Whether you're a patient sniper or an aggressive counter-trend trader, you'll have a clear map. Strategy 1, the sniper, conservative. This is a breakout confirmation play. The condition, wait for a 1-hour candle to close decisively above 68,472. Once that prints, place a buy limit order at 68,450. You're buying the immediate pullback to the breakout level, treating it as new support. Your stop loss goes at 68,100, just below the breakout candle's low and beneath the cluster of 5-period and 20-period EMAs on the 60-minute chart. Take profit 1 is 69,200, exactly the next resistance. Take profit 2 is 70,600. That's a stretch target that gives you a fantastic risk-reward ratio of 1 to 3.2R. The trade is void if price slips back below 68,200 within 4 hours of the breakout. That would signal a failed breakout and a possible trap. This setup respects the trend, buys strength, and gives you an institutional entry with a tight stop to the sniper, conservative, entry. 68,450 limit, after 1-hour close above 68,472, stop loss. 68,100 take profit 1. 69,200 take profit 2, 70,600 risk, reward, 1:3.2R invalidation, void if price drops below 68,200 within 4 hours, strategy 2, the active trader, standard. This one is for those who want to buy a dip and not chase the breakout. The setup, wait for a pullback to the 66,500 zone. That's where the 20-period moving average on the 4-hour chart aligns with the prior resistance turn support area. Place a buy limit at 66,500. Your stop loss goes at 64,750, just below the daily support at 64,820, giving the trade room to breathe. Target 1 is 68,000, near the current highs. Target 2 is 69,200. Once target 1 is hit, move your stop to break even and let the runner run. This gives you a solid 1 to 2.5 setup with a much higher probability of getting filled than chasing a breakout. This trade exploits the mean reversion tendency of an overbought market within a strong trend. The only thing that voids it is a daily close below 64,750. That would mean the trend structure is broken and you exit immediately. The active trader, standard, entry, 66,500 limit stop loss, 64,750 take profit 1, 68,000 take profit 2, 69,200 risk, reward, 1:2.5 R, trailing stop after TP1, invalidation, void if daily close below 64,750. Now pause. Type your Nikkei range for tomorrow in the comments. Give me your high and low. Let's see who's aligned with the key levels. I'll be reading them. Strategy 3, the aggressor, high risk. This is a counter-trend short for those who can lose small and manage risk with discipline. The trade, seller rejection at 68,500. If price spikes above the resistance, then reverses sharply, you can enter a short with a very tight stop at 68,700, just above the intraday high. The thesis is a false breakout that traps late longs. Targets are 67,000 and then 66,500. This is a momentum fade play that relies on the RSI divergence and stochastic rollover we talked about. If the candle closes above 68,700 on any time frame, you're out, no questions asked. The risk reward here is around 1 to 2.5 R, but the probability is lower because you're fighting the primary trend. Only take this if you are prepared to be wrong quickly and take a small loss. This is not for the faint-hearted. It's a high-risk sniper shot against the crowd. The aggressor, high-risk, entry, 68,500 short on rejection, 1H close below 68,400 confirmation, stop loss, 68,700 take profit 1, 67,000 take profit 2, 66,500 risk, reward, ~1:2 R invalidation. If any hourly candle closes above 68,700. Quick risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news like BOJ minutes or US ISM. Stops are non-negotiable. This is how you survive to trade the next big move. Protect your capital first, profit second. Let's wrap with the close and retention loop. The single most critical level for the next session is 68,472. A daily close above it flips the gate wide open to 70,600. A failure there, and especially a break below 66,281, turns this entire melt-up into a textbook bull trap. Tomorrow's wildcard is the BOJ minutes. If there's even a hint of policy normalization, the yen will scream higher and the Nikkei could see a 2,000-point freefall in hours. If you want the full breakdown on US dollar to Japanese yen and how the yen carry trade is driving this entire move, that video is live now. Tap the end screen. Smash like if this gave you a clear, executable plan. Subscribe, hit the bell, and I'll see you in the next one. Stay sharp.